This week here on the podcast, we're back with the prediction show. We're going to talk about last year's predictions from the guys and look at 2026's predictions, as well as check out a Grumpy Grandpa segment as well. So we're going to dive into the podcast this week with Matt and Steve. Let's get it on. Hey everybody, welcome into the podcast. Thanks for hanging out with Matt, Steve, and myself as we talk investing, finance, and retirement. And guys, welcome back in. Steve, you feeling better, my friend? Good to have you.
I'm feeling much better. I missed you guys. It seems like it's been forever since I've been in here.
Yeah, we missed you too.
Yeah.
We did a show.
I learned you turned 40 years old and snacks can take you down for a week. So diverticulitis from a bag of granola.
Man,
I heard the end of it from my buddies. So
yeah, that's true. They'll get you.
And
for
this
that.
guy over here.
I was gonna say your buddies, your brother had to get you. But well, we got a good show lined up. Matt, you doing all right this week, my friend?
Doing great. Excited to talk about our predictions. Revisiting. We promised we'd revisit it if the predictions turned out okay. So
well, let's get into it. I know you got some slides for us, so let's break it down.
Yeah, so let's kind of go back to the beginning of January 2025. Everyone was bullish with the exception of one company, and that being First Trust right there. You can see their prediction was S&P would end up at 5,200, so pretty bearish. And then I have highlighted where the S&P actually ended up at, which was darn close to 7,000, 68.46. The S&P was up 16.4% on the year, so it actually fell between the highest and lowest predictions. We talked about back in January of 2025, how for the prior 5 years, the S&P actually was out of the highest and the lowest predictions. So it's so hard to predict on a year-to-year basis.
Yeah. I think a lot of these companies too, they take their predictions serious, but then you always get those flyer companies, and it seems like it's First Trust lately. I mean, if you go in with a wild prediction like that, and you just happen to get it right, you can use that for years. Look at where everyone else was at, and this is what we came in at, and we were right, and they were all wrong.
Yeah.
And if you're wrong, you just go, hey, forget about last year's, or you double down and do the same thing again this year, which is exactly what First Trust is doing.
Yeah.
But a lot of these are just for entertainment purposes. I mean, we as humans, we want to be entertained, and that's all this is. We go to the dentist office, and there's a Newsweek magazine and a People magazine sitting on the coffee table. Most of us are picking up the People. This is like the financial version of People magazine to me. These predictions mean absolutely nothing. Like we were just talking earlier, go back to 2020 and you look at the predictions, and most firms were bullish, and then we didn't see that black swan, the pandemic happen, and it's like, oh, we need to change our predictions. But then we didn't see us printing ourselves out of the pandemic. And it's like, well, let's go back to my original prediction that I had at the beginning of the year before I knew there was going to be this black swan. And it's like, this is nothing but, nonsense to me, really.
We actually did an episode. It was back in April or May when the whole Liberation Day was happening, and everyone was adjusting their price targets. They said, hey, we were at 7,000, but now we're going to bring that to 6,400. And then you had asked me, you're like, are you going to keep your 7,000? And I said, yeah, sure. I mean, this is all a guessing game. And is the market going to come back? I think so. Didn't necessarily expect it to come roaring back like it did, though.
It got really close in January to that 7,000, right? I mean, it peaked right up to it.
It did hit it. If you would have given me the month of January, I think it peaked out at 7,000.
Oh, did it hit the 7? Oh, I thought it stopped.
But it did.
Okay. All right.
Yep.
First Trust was taking a victory lap there for a little bit after Liberation Day.
Yeah. And now they're doing the same thing. So that's what you mentioned, Steve. So 2026 predictions from these big companies here. Again, the same two companies on the left and the right. Oppenheimer was the most bullish last year. First Trust was the most bearish. So that didn't change. The numbers changed a little bit, though. So First Trust is now calling for 6,000 instead of 5,200. And Oppenheimer's now over 8,000. So wild thing is we're going to be seeing potentially 10,000 here by the end of the decade.
That's a little interesting. And certainly, and this is based on the S&P, right? So you could do a whole nother one on the NASDAQ or the Dell, but it's a good cross section. All right. What else did we have? What else are the predictions did we have? What about you guys?
Yeah. So we'll revisit our predictions. That we made here. So we both batted 500, which by baseball standards is Hall of Fame worthy.
But I feel like you got to give us the first one up top here. We got two X's, but it fell right in the middle of both of
Right.
our targets. So
Right. And I was pretty darn close at 7,000 plus, but of course it ended up just shy of that. But my bold prediction, if you were to go back and listen in January, something that was not priced in at all was the Fed cutting more than 2 times, which they ended up cutting 3 times. At the very end, the last 3 meetings were all cuts. So it was mid-December that this prediction came true. And that allowed bonds to act like bonds again. So the aggregate bond index returned over 7% last year, which kind of gets lost with the market performing so well.
Yeah.
But it had been a really rough year. The 5-year return on the aggregate bond index is still negative because we're looking at 2022, which is pretty much a black swan event for bonds. And then my final guess was NVIDIA leading the Magnificent Seven, which was also a very close call there, because you can see Google really eked it out in the last couple months. So if we would have called it in November, NVIDIA would have been leading, but Google really turned it on towards the end of the year.
I think it'll be NVIDIA this year, though. I like that prediction. Carry that prediction into this year.
Is that what you're gonna roll with that?
I'll steal that one from you. Yeah. Well, you look at mine. I mean, the first one, the S&P has a 10% drawdown. We saw that. I honestly think we might see that again this year. I had a lot of clients go, I can't believe you actually called that. It's really common. I mean, that happens, every 16 months on average, we see that 10% drawdown. I mean, on average, we see 5% drawdowns every single year. So, I mean,
Steve, if it does 10% like that, that's technically a correction, right?
Yeah, I mean, you could call it correction territory, yeah.
Okay.
But we see those intra-year drawdowns, and I think we'll see another one this year. We could even see 15%. Beppin was talking about it on the State of the Markets that they did last week, and he talked about a 15% drawdown and how that happens every 3 years. We're due for a 20% drawdown.
We just had one last year. Your 10% was actually 20. In Liberation Day, it was about.
Yeah, I was going to say, with everything being so politicized and publicized, it's like that's actually normal. But I just saw a headline 2 days ago before we taped, and it said stock market crashes again. And I thought, wait a minute, it crashed again. So I go look, and it was 0.2%, right? And I'm like, the headlines are ridiculous.
Yeah, and these crashes are becoming more common because black swan events are happening every other year.
The last couple here have been pretty unique though, because the recovery has been so fast.
Yeah,
so they're not too painful. I mean, you look at some of these we haven't seen a 20% drawdown where we hold that for a while in a long time. So,
right.
And I'm not calling for that this year. I don't think we're going to see a 20% drawdown. I think we will see another 10%. I think we'll see continued volatility. Matt and I we've been talking about that quite a bit on this podcast, though, for the last few months, handful of shows that we've done.
Yeah.
Emerging markets did very well, outperformed the S&P 500. Small caps just continue to lag. I'm going to stay away from those this year. I think they might do better, but
I'll go ahead and take that. So I'll trade NVIDIA for your small caps.
Okay.
And then in value, value did well. It didn't outperform growth. I mean, the Mag 7 led the way again. I do think value does quite well this year. I'll double down on that. I'll say it outperforms growth this year.
I could see that. And really all these moves are showing up within our models as well. Mm-hmm. So as we talked about on the last market update with Beppin, we've been phasing, I don't want to say phasing out of growth, but reducing our exposure to the Mag 7, to the tech world. And we're seeing some potential cracks already with software having absolute meltdown year to date. So we are pretty optimistic on value. Just getting a little bit more boring. Value and bonds. You have to remember, retirement planning is about being boring. Right. It's not about the hot, flashy stocks. So value, bonds, get paid to hold it, and potentially avoid some of this volatility that we're expecting.
We like the risk reward on bonds too. So, I mean, you look at a model like our moderate growth model, we're increasing bond exposure there because, again, the risk reward is really nice. I mean, I think we could see, 6-7% in fixed income again next year within that model. And you compare that to equities, like Matt just talked about, especially on the tech side, these valuations they're getting a little bit out of control and slightly concerned about them. And again, we got to go in. We're managing money for predominantly retirees. We got to go in and we got to take some of these gains off the table. And it's all about a balanced approach in retirement.
Yeah. So we don't necessarily have predictions laid out like we did last year, because we kind of made these as a joke where it's like predictions don't matter, and
I'm looking at yours, and I'm gonna steal. I think bonds will continue to act like bonds again. That's why we're increasing exposure in my growth, and then I think the Fed cuts. I'll say 2 times or more. I'll just tweak that one a little bit. Everyone's so concerned about Kevin Walsh. Yeah, they keep showing these clips of him, from 10, 15 years ago where he had a hawkish stance. It's like, it doesn't mean he's still hawkish today. They want a white hot economy. Again, Mike and Beppen touched on this last week. They want him to cut rates. I think we see it 2, maybe 3 times this year. I think they'll get what they want.
Yeah. And I guess if I were to make a prediction, I don't think it's going to be a bear market. I don't think it's going to be a continued bull market. I think investor psychology might be a little bit weird this year with just constantly being at all-time highs. It seems like a new headline drops every day in terms of whatever it may be in terms of geopolitics and rule changes and this and that. I think it's going to be more like a kangaroo market, up, down, and maybe ends within that 0 to 10% range, which might drive a lot of people crazy.
Yeah, well, we get spoiled, right? So after seeing 4 years plus, 17 plus, on average over the last 4 years or whatever, having like a 10% normal S&P would almost be like shocking. And they'll probably say, "Oh, the market, look, the economy's terrible," right, or something like that. So I guess a lot to be seen.
That'd almost be too boring, right? Just a smooth 7-8% growth in the S&P, no volatility.
Well, you can't sell that, Steve. Like, it's not sexy, all right?
Yeah.
So. All right. Oh, good. All right. What else we got?
So, we were talking, we wanted to play a Grumpy Grandpa video for everybody, because this is a kind of a joke we started internally, just playing with AI, seeing what it's all capable of.
Well, let's add some Grumpy Grandpa.
When the market's running hot, everybody gets brave. Oh, yeah, I can handle risk. Sure you can. There's a big difference between risk tolerance and risk capacity, and retirees mess this up constantly. Risk tolerance is how brave you feel. It's that cute little questionnaire your advisor gives you. On a scale of 1 to 10, how sad would you be if you lost money? Yeah, real scientific. Risk capacity is different. It's how much risk you can take without blowing up your life. You might feel fine watching your portfolio drop 30%, but if you're 67, retired, and pulling income every month, you might not have the capacity. It's like saying, "I'm comfortable jumping off a roof." Great, but your knees aren't. In retirement, risk capacity usually shrinks. Subscribe for more retirement rants. Or don't. What do I care?
I like it. I like Grumpy Grandpa. He's got to get a little more attitude with that last little bit. Or don't. What do I care? Right?
This was not based off any of our clients in any way. No.
I think we let the cat out of the bag last week. I think Matt or last show. It's actually him, but yeah.
Yeah, the problem is a few of our clients were like, "What is this? I can't find it." They don't necessarily know about the short tab. So you got to click not videos but shorts. It's kind of like a TikTok for YouTube.
Yeah. We'll put some links in the regular show descriptions to try to help people redirect back around to it so they can check that out a little bit. But yeah, good stuff. All right, that's going to do it this week for the podcast. Don't forget to subscribe to us on Apple, Spotify, and of course right here on YouTube. Retirement Approved. You can find them online. We'll have show links in the descriptions below. If you got questions and concerns about how things are going to work for your situation, as always, talk with qualified professionals like Matt and Steve and the whole team at R.W. Paul and Associates. You can find those links down below, and that way you can get some time on the calendar and have that conversation. And we're going to talk about some financial hot takes. I'm going to put the guys on the spot on the next episode. Since those reaction videos are all the rage, we're going to do some reaction to some financial talking heads out there and see what the guys think on the next episode of Retirement Approved. For Matt, for Steve, I'm your host, Mark Killian. We'll see you next time.
Retirement Approved is brought to you by Richard W. Paul and Associates, an SEC-registered investment advisory firm. Throughout the presentation, we may generally discuss different financial vehicles. However, nothing we say should be construed as a recommendation to buy or sell any financial vehicle, nor should it be used to make decisions today about your investments or insurance. For full disclosures, check the show notes of today's episode.